Is Acorns recession-proof? It's a question many investors, particularly those just starting out or looking for a hands-off approach, are asking as economic uncertainty looms. We've all heard the whispers of potential downturns, the news reports of inflation, and the cautionary tales of market crashes. In times like these, the desire for financial security becomes paramount. So, can a micro-investing app like Acorns truly stand strong when the economic tides turn? Can it protect your hard-earned pennies and even help them grow when everything else seems to be shrinking? To answer this, we need to understand a few key things about Acorns and about recessions themselves. First, what exactly is Acorns? At its core, Acorns is a robo-advisor that helps you invest your spare change by rounding up everyday purchases to the nearest dollar and investing the difference. It also allows for recurring investments and offers different portfolio options based on your risk tolerance, from conservative to aggressive. These portfolios are typically made up of exchange-traded funds, or ETFs, which hold a diversified mix of stocks and bonds. Now, what is a recession? Simply put, a recession is a significant decline in economic activity spread across the economy, lasting more than a few months, normally visible in real GDP, real income, employment, industrial production, and wholesale retail sales. It's a period where businesses might cut back, unemployment can rise, and consumer spending often decreases. The stock market often reacts to these changes, with prices tending to fall. So, when we ask if Acorns is recession-proof, we're really asking if your investments within Acorns can withstand the pressures of an economic downturn and potentially even thrive. The straightforward answer is no investment is truly recession-proof in the sense that it guarantees returns or zero losses. All investments carry some level of risk, especially during volatile economic periods. However, Acorns' approach to investing does incorporate several principles that can help mitigate risk and even position you for long-term growth, even through a recession. Let's break down how Acorns' core features and strategies interact with a recessionary environment. 1. Diversification, the bedrock of Acorns' strategy. Acorns builds diversified portfolios using ETFs. Diversification is essentially the practice of spreading your investments across various asset classes, industries, and geographies. The idea is that if one part of your portfolio underperforms, other parts might do well, cushioning the blow. During a recession, some sectors or companies will undoubtedly be hit harder than others. For example, discretionary spending might plummet, impacting retail or travel, while essential services like utilities or healthcare might remain relatively stable. Acorns' pre-built portfolios are designed to be diversified. Even their most aggressive portfolios will hold a mix of large company stocks, small company stocks, international stocks, and real estate, in addition to some bond exposure. More conservative portfolios will lean heavily into bonds and cash equivalents. This inherent diversification means you're not putting all your eggs in one basket. While your overall portfolio might see a dip during a recession, the diversification aims to prevent catastrophic losses that could occur if you were heavily concentrated in a single, struggling asset. 2. Dollar cost averaging, your secret weapon in a down market. Perhaps one of the most powerful aspects of Acorns, especially during a downturn, is its emphasis on dollar cost averaging. This is the strategy of investing a fixed amount of money at regular intervals, regardless of market fluctuations. When you use Acorns roundups or set up recurring investments, you are essentially dollar cost averaging. Why is this so beneficial in a recession? When the market is down, asset prices are lower. By consistently investing the same amount, you automatically buy more shares when prices are low. Think of it like a sale at your favorite store. You're essentially getting your investments on discount. While it might feel counterintuitive to keep investing when your portfolio value is dropping, history shows that those who continue to invest during down markets are often in a stronger position to capitalize on the eventual recovery. When the market bounces back, as it historically always has after every recession, those cheaper shares you acquired can lead to significant gains. Acorns' automated nature makes this strategy effortless, preventing emotional decision-making like panic selling, which often locks in losses. 3. Long-term investment horizon, patience is a virtue. Acorns is fundamentally designed for long-term investing. Their educational content consistently emphasizes the importance of staying invested and riding out market volatility. Recessions, while painful, are typically temporary. Historically, economic downturns are followed by periods of recovery and growth. For younger investors or those with a long-time horizon until retirement, a recession can even be viewed as an opportunity. The lower asset prices allow for greater accumulation of shares that have the potential to grow significantly over decades. Acorns' later IRA accounts, for example, are specifically geared towards retirement, encouraging a long-term mindset where short-term market fluctuations are less impactful. 4. Risk tolerance alignment, matching your comfort level. Acorns offers different portfolio options, from conservative to aggressive. Before you even start investing, Acorns will ask you questions to gauge your risk tolerance and recommend a suitable portfolio. This is crucial during a recession. If you have a low risk tolerance, you'll likely be in a portfolio with a higher allocation to bonds, which tend to be less volatile than stocks during downturns. While these portfolios might offer lower returns during bull markets, they also provide greater stability when the market is struggling. The ability to choose a portfolio that aligns with your comfort level means you're less likely to panic and withdraw your funds when the market gets rocky. This predetermined strategy helps remove the emotional component from investing, which can be a significant pitfall during recessions. 5. The role of fees, a double-edged sword. Acorns' fee structure is a flat monthly fee, $3 for the basic personal plan, $5 for Personal Plus, and $9 for Premium as of my last update. While this simplicity is attractive, it can become a higher percentage of your assets if your account balance is very small, especially during a market downturn when your balance might temporarily shrink. For instance, if you have only $100 invested, a $3 monthly fee represents a 3% annual fee, which is relatively high. During a recession, if your account value declines, that flat fee might feel more impactful. However, as your balance grows, the percentage cost of the fee decreases. For many, the automation and ease of use offered by Acorns might outweigh this perceived higher cost for smaller balances, particularly if it encourages consistent saving and investing that otherwise wouldn't happen. It's important to consider your account balance and how the flat fee impacts your overall returns, especially during periods of negative growth. With that said, thanks for watching, and until next time.